There is a very specific moment in any major economic crisis when the warning signs appear before the collapse. It is not when prices crash in the newspapers, nor when panic dominates the headlines. It comes earlier than that. It happens when those inside the system begin to change their behavior quietly. And that is exactly what is happening right now in the U.S. housing market. While much of the public believes that falling mortgage rates should automatically reignite the market, something entirely different is being recorded behind the scenes. Homebuilders, the companies that live off selling houses, that feel the real pulse of demand, are losing confidence. Not in a sudden or dramatic way, but steadily, coldly, and mathematically. Industry sentiment fell again at the beginning of 2026, and this is not happening by chance. When those who build homes begin to doubt the immediate future, it means the problem is no longer isolated. Lower rates, incentives, discounts, and bonuses are no longer enough to bring buyers back. What we are seeing is not just a natural slowdown in the housing cycle. It is a progressive exhaustion of the market's ability to absorb supply. For years, the American housing market was supported by three main pillars: relatively accessible credit, continuous home price appreciation, and the belief that demand would never disappear. All three pillars began to crack at the same time. First, with the aggressive rise in interest rates. Then, with the compression of household purchasing power. Now, with something even more dangerous: the silent withdrawal of the qualified buyer. The data show that home sales remain stuck at historically low levels, not because there are no homes for sale, but because the prices of those homes no longer align with the economic reality of those who are supposed to buy them. Even when financing becomes slightly cheaper, the total cost of housing remains out of reach for millions of Americans. And the market feels this immediately. Homebuilders know this better than anyone. They see inventories growing. They see contracts taking longer to close. They see buyers visiting properties, running the numbers, and walking away without signing anything. This behavior does not appear in flashy headlines, but it shows up in internal reports, downward revised projections, and decisions to cut prices before it is too late. And cutting prices in this sector is never a sign of strength. It is a defensive mechanism. When a builder lowers prices, offers free upgrades, or absorbs part of the financing costs, it is trying to push stagnant inventory off its balance sheet. It is trying to maintain cash flow. It is trying to buy time. The problem is that when many builders do this at the same time, the market begins to send a clear signal. There is more supply than real demand. This excess does not appear overnight. It is the result of years of construction based on expectations that did not materialize. There was an assumption that demand would be infinite, that buyers would always show up, that prices could rise indefinitely without consequences. Now these assumptions are being challenged in real time. What is most unsettling is that all of this is happening without widespread panic. There are still no rows of abandoned houses, nor dramatic price collapses across every state. But this is precisely the stage where major corrections begin. First comes the loss of confidence. Then the slowdown. Next, the quiet adjustments. Only at the end does the visible shock appear. Those who look only at mortgage rates may think the worst is already over. But those who observe builder behavior understand that the problem runs deeper. Credit may become cheaper, but that does not fix a market where wages fail to keep up with prices, where the cost of living squeezes families from every direction, and where fear of taking on long-term debt grows with each new economic uncertainty. There is also a psychological factor that cannot be ignored. After years of volatility, high inflation, and economic instability, the average buyer has become more cautious. Buying a home is no longer seen purely as a dream, but increasingly as a risk. This type of shift in mindset does not reverse with a simple interest rate cut. And when the perception of risk takes hold, the market freezes. Home builders understand this. That is why confidence is falling. Not because they do not want to sell, but because they realize selling will become increasingly difficult in the coming months. The issue is not just the present, it is the outlook for the future. And that outlook right now is not optimistic. What we are witnessing is a market sustained more by hope for a reversal than by solid fundamentals. A bet that something external, an aggressive policy move, an unexpected stimulus, a sharp shift in the macroeconomic landscape, will rescue the sector before the adjustment becomes inevitable. But history shows that markets are rarely saved at the last minute. They adjust, sometimes slowly, sometimes brutally. And that is exactly why this drop in builder sentiment deserves maximum attention. Because it is not talking about today. It is talking about what may happen tomorrow. In the next part, we will dive deeper into why declining confidence in the housing sector often precedes broader crises, how this movement connects to banks, employment, and consumption, and why many experts believe the United States is entering a correction phase that has not yet been fully priced in. When builders' confidence begins to fall, the impact never stays confined to the real estate sector. That is a common misreading. Homes are not just physical assets. They are the heart of a complex economic chain that connects credit, employment, consumption, banks, and public policy. And that is exactly why the silent weakening of the housing market is often one of the earliest signs that bigger problems are approaching. The real estate sector in the United States functions as a leading indicator of the real economy. When it slows down, it's not simply because people stopped buying homes. It's because the entire system starts to feel the weight of postponed decisions, recalculated risks, and broken expectations. Every home that fails to sell represents a sequence of impacts that don't immediately show up in official data, but quietly accumulate behind the scenes. Builders slow down construction. With fewer projects, there is less hiring. Fewer workers employed means less income circulating. Less income leads to lower consumption. Lower consumption puts pressure on companies in other sectors, which begin to reconsider investments and hiring plans. This cycle does not start with a collapse, but with a gradual cooling that slowly spreads. At the same time, banks watch all of this with extreme attention. Mortgage lending is one of the pillars of the American financial system. When sales stall and inventories rise, perceived risk increases. And when risk rises, credit becomes more selective. Even if rates fall, requirements tighten. Higher down payments, more guarantees, more caution. The practical effect is simple. Fewer people qualify for financing. This phenomenon creates a dangerous paradox. Rates may appear lower on paper, but real access to credit becomes more difficult. The market enters a state of compression, where liquidity exists but does not circulate. And markets without circulation begin to rot from the inside. Another critical point is the impact on household wealth. For years, real estate appreciation worked as a kind of psychological and financial cushion. Even people in debt felt secure as they watched their home values rise. Now, with the prospect of stagnant or falling prices in many regions, that sense of security begins to fade. When wealth stops growing, behavior changes. People spend less, save more, and avoid risk. This shift directly affects consumption, which is the foundation of the American economy. Less consumption means less growth. Less growth pressures the labor market. And any threat to employment is immediately reflected in people's willingness to buy homes. The cycle feeds on itself. Politically, this creates an extremely sensitive environment. Housing is one of the most explosive issues in the United States. When housing costs rise too much, governments come under pressure. When the market begins to weaken, fear of a crash takes hold. No government wants to be remembered as the one in power when the dream of homeownership turned into a nightmare for millions of families. That is why we see increasingly direct attempts at intervention. Incentives, subsidies, credit programs, bond purchases, optimistic speeches. All of this is part of an effort to keep the system functioning while adjustments happen slowly. But public policy has clear limits when the problem is structural. The structural problem is simple to explain and difficult to solve. Home prices rose faster than people's incomes. For a long time, this was masked by easy credit and constant appreciation. Now, with a high cost of living, pressured wages, and economic uncertainty, the math no longer works. Builders feel this before anyone else because they are on the front line. They see when buyers disappear. They see when traffic at sales offices drops. They see when negotiations drag on and contracts fall apart at the last minute. And when this happens on a broad scale, confidence vanishes. It's important to understand that confidence is everything in this sector. Building a home is a heavy, long-term investment with tight margins. Without confidence in future demand, builders don't take risks. They slow down, preserve cash, and wait. But when many do this at the same time, the entire market enters a holding pattern. This holding pattern is dangerous because it paralyzes decisions. And economies do not grow when decisions are postponed indefinitely. Fear does not need to be explicit to cause damage. It only needs to seep into the everyday choices of companies and households. Another element that is beginning to gain strength is the increase in indirect supply. People who bought properties expecting rapid appreciation now find themselves stuck with assets that are hard to sell. Smaller investors begin to retreat. Large investors become more selective. The market loses marginal buyers, exactly those who had been supporting the highest prices. All of this builds a scenario in which a downturn does not need to be abrupt to be painful. A market can correct slowly and still cause enormous economic and social damage. In fact, slow corrections are often even more exhausting because they prolong uncertainty and erode confidence over time. The central point is that the drop in builders' sentiment is not an isolated data point. It is one piece of a larger puzzle involving credit, income, politics, and collective psychology. Ignoring this signal is repeating past mistakes. Interpreting it correctly means understanding that we are in a delicate transition phase, where small changes can generate major consequences. In the next and final part, we will address the most sensitive issue of all: why this scenario could evolve into something more severe. Which historical parallels help us understand the current moment and what distinguishes a simple slowdown from a true housing market collapse. Every major crisis has one thing in common. It does not begin with a bang, but with silence. Before panic comes the normalization of what is abnormal. Before collapse comes the feeling that something is not right, but not yet serious enough to change collective behavior. The U.S. housing market appears to be exactly at this stage right now. Historically, major real estate corrections have not been caused by a single isolated factor. They have emerged from the convergence of accumulated excesses, unrealistic expectations, and delayed responses. What makes the current moment particularly delicate is the fact that many of these elements are already present at the same time, even if in a fragmented way. For years, a narrative was built that the American housing market was virtually immune to deep crises. There would always be demand. There would always be credit. There would always be someone willing to pay more. This narrative was reinforced by expansionary monetary policies, fiscal stimulus, and a culture that treats home ownership not only as a necessity, but as a guaranteed investment. When that belief becomes entrenched, risk stops being perceived as risk. The problem is that markets do not operate on eternal beliefs. They operate on income flow, confidence, and liquidity. When one of these pillars fails, the others begin to weaken. Today, what we see is income under pressure, confidence declining, and liquidity becoming increasingly selective. This combination rarely ends smoothly. The most commonly cited historical parallel is 2008, but the current scenario differs in some important aspects. The banking system, at least in theory, is more regulated. Lending standards are more stringent. There is not the same volume of explicitly ultra-high-risk credit. This leads many to believe that a similar collapse is impossible, but that comparison can be misleading. Crises do not need to repeat themselves in the same way to cause similar damage. Today's risk is not concentrated solely in bad loans, but in the market's inability to sustain current prices without artificial credit expansion or constant government intervention. When a system permanently depends on stimulus to avoid falling, it is already fragile. Another critical point is the perception of time. In previous cycles, corrections were relatively fast. There was shock, panic, decline, and then reconstruction. The risk now is different. A long period of stagnation with isolated drops, regional corrections, and a gradual erosion of confidence. This type of scenario is even more corrosive because it does not create a clear inflection point. It slowly wears down families, companies, and governments. As prices stop rising, many homeowners realize they are trapped in assets that are less liquid than they imagined. Selling is not easy. Refinancing is not simple. Renting does not always cover costs. This realization changes the emotional relationship with the property. The home ceases to be a symbol of absolute security and begins to be seen as a heavy commitment in an uncertain environment. Builders, once again, are the first to react. They do not operate on hope, but on margins and forecasts. When sentiment falls consistently, it is because perceived risk outweighs expected return. And when that happens on a large scale, investment retreats. Less investment means less future growth. Less future growth means more pressure on the present. Politically, the dilemma intensifies. Intervening too much can further distort the market. Intervening too little can accelerate the correction. Every choice carries a cost. Incentive programs alleviate symptoms but do not solve the root of the problem. Restricting investors may help in one area and hurt in another. Buying time is not the same as fixing the imbalance. Meanwhile, the average citizen is caught in the middle. Those who have already bought fear losing value. Those who have not yet bought fear entering at the worst possible moment. The result is paralysis, and paralyzed markets are vulnerable. The real danger is not an instant, spectacular crash. It is a prolonged adjustment process that slowly erodes collective confidence. When people stop believing that the future will be better than the present, they change everything: how they spend, how they invest, how they work, and how they vote. The housing market, in this sense, is a mirror of social psychology. The signal sent by the drop in builder sentiment should not be seen as an isolated alarm, but as part of a sequence. First, confidence falls. Then, investment retreats. Next, employment feels the impact. Finally, consumption slows. When this cycle is complete, the correction ceases to be a possibility and becomes a consequence. None of this means that collapse is inevitable or immediate, but it does mean that risk is being underestimated. It means that the optimistic narrative no longer stands on its own, and it means that, once again, the market is warning before it acts. Ignoring that warning is comfortable in the short term. Facing it is uncomfortable, but necessary. Because in the end, major economic movements do not punish those who err on the side of caution. They punish those who insist on believing that this time will be different. The U.S. housing market is entering a decisive phase. There is still room for orderly adjustments. There is still time for controlled corrections. But that time is not infinite. And the silence we see now may very well be the final stage before deeper changes. The question that remains is not whether something will change. It is how and when. And those who understand the signals before the majority are rarely caught by surprise.